Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, June 28th, end of Q2. What did we see? Same as we've seen all year. Large cap growth, very strong. As a matter of fact, NASDAQ finished Q2 with a 7% gain, pushed it almost up 17% or so for the year. S&P 500, about half of that, but a 3 and change type of gain. S&P up nearly 15%. Contrast that with negative performance in Q2 from both the Dow Jones and the Russell 2000. We'll see if any kind of bid comes calling for the value-oriented indices in comparison with the growth. Which brings me to something I want to share with you this week, chart-wise. And you often hear me talk about growth versus value, cap-weighted versus equal-weighted. And I wanted to bring a little detail to that. Great chart put up by Charlie Bellello, who is with Creative Planning, puts out some great charts on Twitter if you want to visit there. In terms of what we're looking at here is cap-weighted S&P performance versus equal-weighted S&P performance going back to 1971. Remember, they're the same stocks. Cap-weighted is weighted for size. Equal-weighted is one stock, one vote. So in our core account, in our core strategy, US Core, we like to try to analyze how we should weight those holdings. So obviously anything cap-weighted is done very well in all strategies, whereas equal-weighted has suffered. Let's take a look at if we can pick up any precedents, anything, if this chart can impart any knowledge to us going forward. Let's take 2023, just so we're all on the same page. Last year, S&P cap-weighted up 26.3%. Equal-weighted only up 13.9% for a 12.4% cap-weighted outperformance. That's what we're discussing here. Through 2024, another 9.9% outperformance. Now, those are extremes when we talk about dispersion between the same index, cap-weighted versus equal-weighted. We have to go back all the way to 98 and 99, which is highlighted in blue, to see the same kind of outperformance from the cap-weighted index. Now, that extreme ushered in a long period of equal-weighted outperformance. I remember it as clear as day, and clients, we've had this discussion going back 20, 25 years ago. There was almost no reason to own cap-weighted coming out of the 2000, 2001, 2002 correction. Everything was equal-weighted. If you owned cap-weighted, you suffered. All that strength in equal-weighted, and look at 2000 through 2006, through 2009, 10, all that equal-weighted extreme ushered in cap-weighting. So money will continue to search for where it can be treated best after extremes. So we don't know if we're at an extreme right now. We don't know if cap-weighted will continue to dominate equal-weighted, but we at least want to be cognizant of where some switches and some reversion has happened in the past. Now, is it easy enough just to say, we've gotten this kind of performance, we have to lean equal-weighted going forward? No. Why? Because if we said that same thing in 2003, let's say, right? Let's go to that chart. At 2000, you had 18.7% outperformance in equal-weighted. You had 11.5% outperformance in 2001, 4% in 2002. At that point, you may have said that extreme has to reverse. I'm going to overweight cap-weighted. What happened? Equal-weighted continued to dominate. So very dangerous to draw a line in the sand. What I wanted to share here was some of the analytics that are important when positioning capital and some things to think about. Remember, most of the time, these two indices trade within a reasonable dispersion of each other. But when we're looking at extremes, we want to be aware. So I hope you enjoy the chart. You can print that out. It is something very historical that can really give you a bird's eye view into the markets that you may have been trading 10, 20, 30 years ago. Enjoy the weekend. We're going to toss it over to John Mousseau, who's taping remotely this week. Quick point, John taped this earlier in the day. As the afternoon wore on, we saw some softness in interest rates. In other words, interest rates rose. I think the 10-year Treasury went from somewhere in the 427 range from when John was taping to 437 or 438. Couldn't find any real reason for it. We'll be investigating that next week. Take it away, John.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday morning on June 28th around 9 o'clock. This is the bond report for the week. Big number this morning, the PCE number, personal consumption expenditure. The market had been waiting for this. This is the Fed's favorite measure of inflation, as we've talked about in the past. Good number. Month over month for PCE was 0, just what was expected. Core PCE month over month 0.1, just what was expected. Not a big change in the bond market. In fact, not a big change in bonds for the week. So if you look at the 10-year bond around a 427, it's up a tick for the week. 2-year bond is down a couple of ticks for the week. Muni yields are probably up 2 or 3 basis points at most. And in fact, with today's action, will probably be unchanged for the week as well. When you look at it, it is what the market wanted. It's been focused on that. You know, other economic numbers, for the most part, have been softening. This is in line with that. And these are the kind of numbers the Fed wants to see if they're going to cut rates down the road. We will see whether this continues. Things like pending home sales down this week, down a decent amount. Durable goods pretty much in line, smaller numbers. So most of the economic numbers out there are either flat or declining somewhat. Used car prices continue to decline, example. When we look at things like that, it is setting the table for the Fed to cut rates down the road. Whether it comes, before the election or after the election, we don't know. I suspect it would probably come in September, and they would not want to do one in November right before the election. Speaking of the election, everybody saw the debate last night, somewhat underwhelming performance from the president. The bond markets really don't read much into this. It would be more in the equity markets, but kind of important to remember if you went back to the election of 2016 when Trump kind of surprised everybody by winning. The overnight numbers on election night went from bond yields really down and stock markets going, in other words, bond prices up and stock prices down, and it turned around by the time that you got to the knowledge that Trump was going to win the presidency. And then yields started to go up and stock prices started to go up. And yields continued to go up right through the beginning of 2017. Turned out to be a great time to buy bonds with those elevated yields. Since we already have that history in the past, I don't expect to see a lot of movement, whether there's more poll movement towards Trump or not. It's something that we're going to watch here. Of course, next week we have a very important number. We have the jobs number next Friday. Bond prices could be a little volatile next week, mainly because we have the holiday, so we will be watching that as well. Another important note is on municipal bonds. Biggest amount of money coming into the market during the year. It's from maturing bonds, it's from called bonds, it's from coupon payments. and that's probably totaling somewhere in the neighborhood of $30 billion plus. So that should provide some very firm support for the municipal bond market as we begin the second half of 2024. We hope everybody has a great weekend. Everybody have a great 4th next week, and we'll talk to you soon. Thanks a lot.
Thanks so much, Moose. Great data. See you next week.